Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about how to best use annuities in a rising interest rate environment. Right now, interest rates are higher than they've been in a long time, and people are taking advantage of annuity contracts because of that. I'll just tell you, with just like even 4 or 5 years earlier, we were looking at around 200 billion in annuity sales. Pretty big number, but now we're at over 500 billion. And it's just because people are able to lock in a lot of lifetime income. They're also able to lock in high rates from MYGAs, which are called MYGAs for multi-year guaranteed annuity contracts. They're the annuities world version of a CD. So the rates on those are very good as well. If you want to check rates right now, go to my website, johnstevenson.com, and you'll be able to check all of the rates of all of the annuity contracts that are available. They're being influenced in a very good way by the rates. When rates are high, income is high, and so are the fixed rates. And it affects SPIAs and DIAs as well. So they're very, very good right now. And a rising interest rate environment is really, really good for payouts. We don't know how long that'll last. Definitely when interest rates go down, that does affect annuity payouts. But we don't know how much until that actually happens. Last year, when they had a peak of interest rates and then it went down a little bit, it did affect some of the payouts. They did change a little bit. Not too bad, but it's definitely good if things are at their peaks, which they are right now. Then it's definitely good to seriously look at purchasing an annuity. If you're already in the market for one and you're thinking, I'd like as much lifetime income or I'd like just to get the highest rate, then definitely check out my website. And if you're thinking about purchasing one, book a call. There is a link there on my website. You can go down to the link below as well and book a call with me. So I'm going to share my screen. I want to show you exactly what's available just so you can kind of get an idea of what interest rates are doing right now. All right, so for this particular example, it is a client that is 58 in New Jersey. I actually work with a ton of people in New Jersey. And we'll say for this example, it's 600,000. And then their spouse is 57. Okay, and let's say they start income at 60. Okay, they want to wait 2 years and they're going to start lifetime income based off of 600,000. Okay, well, you can see right here that Prudential is the highest. They're paying 43,639. They're followed closely by Corbridge, Delaware, Athene. They're all really close. And then so on. You got all the rest of the carriers. So if you're looking for highest payout, though, Prudential is it. Now, that's for 2 years. If they were to say, well, I'm not going to take this till 62 because I'm going to wait till I can take Social Security and I want to get as early as I can, then that's perfect. Now, you can see Corbridge is the highest, 52,260, and this is a joint payout. Okay, Prudential's down here. They're still pretty good, but they're not as competitive when it's taken out for 4 years deferral. Now, if I was single, okay, that's going to change the payout as well. So if you're on the hook for just one life versus 2 lives, you're going to pay out more. And so with these, you see Delaware is the best for a single payout. It's almost 58 grand. Then you got F&G, Corbridge as well. So Corbridge is not far behind. Like if you were to pick Corbridge and you were saying, all right, we're gonna take joint income, but I'm not sure. It might be a single payout. I just don't know. Maybe you're not married and you're thinking about getting married, or maybe you've got separate finances and you don't really want to do a joint payout. You'd like to get as much as possible from 2 separate annuities. You can do that too. But looking at this, it's 58 grand guaranteed for the rest of your life. So that's really, really good. So that's for a single payout. So yeah, rates are good. They're just influencing these numbers and they're influencing the amount of lifetime income that people can secure for themselves. And if we looked at, let's see here, if we looked at what this looks like over until age 95, yeah, it's like $2 million, almost. Pretty good from $600,000. So you bought a pension that's worth $2 million. That's what you did. And that's just because interest rates are so good. And because of that, insurance companies are able to give you higher lifetime income because of that. All right, let's take a look at the MYGAs. Maybe you're thinking, I just like some fixed rates. Well, if we look at top MYGAs, let's just look at the top ones because there's hundreds on each one of these. And if you look on my website, you'll see what I mean. You can click on each one of the terms that you're looking at, maybe a 5, 7, or 10 year, whatever it is that you're looking at, and it'll show you a whole list of what's available. Okay. All right. See 2 years paying almost 5%. 3 years is definitely a lot better. 5.7, 5.5. Okay. 4 years, 5.3. 5 years, 5.8, 5.7. 5 year and 7 and 10 are usually the sweet spot for these. Let's look here. 6 years. It's not bad. Oxford, though, it looks like they're going to lower that rate here soon. Let's see here. 7 year, 5.8, 5.75. Really good rates here. 8 years, not bad. 9 years, not bad. If you're looking for 10 years, Revol 1 is giving you 5.9. Wow, look at that. Let's look at that illustration. Just see what that looks like. So 5.9 compound interest. Now, all of these are compounded interest. Some are simple interest. So sometimes you'll go to my website and you'll think, wow, 6.3%. Yeah, a lot of those are simple interest. Not always. I mean, every once in a while we get lucky and we get one that's compounded. But most of the time when you're looking at really high rates, make sure you look at the base rate, which is like, higher. And then if you have a yield to surrender that is lower, that's how you know that it is a simple interest versus a compounded rate. Okay, so and you'll see that on my website. If you go to the MYGA calculator, you'll be able to actually see a base rate. If the base rate equals yield to surrender, then you know it's a compounded interest rate. If the base rate is higher than the yield to surrender, it's always a simple. All right, so if we look at this, compound interest 5.9. Let's see, what do we put? 600 grand in? Yeah. So 600 grand times 5.9. First year earnings, 35,400. And if you let it compound every year, you can see it growing with the last payment of being 59,302 with a total earnings of 464,000 guaranteed. And that puts your account balance at 1,064,000. Pretty good. So these are very simple. There's no fees. There's no hidden fees. The fees would be as if you canceled it. If you canceled it, see the surrender charges right here? They show you the surrender value. Here's the surrender value. So let's say you canceled after like 2 years. That's kind of your break-even point because now you could take out more than you put in, 619,000. But yeah, you don't want to do that because look at the account value over here, 672. Yeah, you don't want to do that. So definitely wait. But you can see over time the surrender charge goes down. And then, if you waited even 6 years, yeah, you pull out 812 instead of 846. So again, highly recommend when you're looking at these, use money that you don't need. Okay. And if you do need it, maybe you need withdrawals, then we'll pick one that allows for withdrawals. Okay, a lot of these will give you 10% withdrawals or just interest only. Some of these won't allow any withdrawals at all. So a lot of times the higher rates won't offer any withdrawals. Okay, they give you more growth if you lock up your money instead of allowing some of it to be taken out as free withdrawals. So something to think about. But if you are thinking about purchasing an annuity and you're thinking, I would like to take advantage of high interest rates while I can, okay? Especially if the Federal Reserve decides to lower their rates in September, that will change things for a lot of these. And a lot of times, insurance companies will lower their rates anyways. Even if the interest rates has not been lowered yet, sometimes they will anticipate it. And if they anticipate it, sometimes they will lower it ahead of time. So I can't control that. They sometimes don't even tell us. Sometimes they will tell us. Sometimes we don't get the memo. Okay. So if you want to lock something in, it's locked in as of the date of the application because it's going to take a week or two to get the money there. But it is locked. Okay. So if rates go down, you're still locked into the highest rate. And if rates happen to go up, you actually would get the higher rate. So it's kind of nice. Anyways, if this is valuable to you, make sure you like, subscribe, share. If you want to look at annuities for yourself, go to my website, johnstevenson.com, and check out my annuity calculators. They have direct feeds with all of the insurance carriers, and it allows you to see exactly what's available, regardless of what the commissions are to me. Okay, a lot of times the higher payouts pay me less commission, but it's still important for you to see what's available so you can choose for yourself. And if that makes sense, you want to book a call to talk more about it, there is a link below this video. There's a link on my website to book, and I'd love to help you. So anyways, hope this has been helpful. And if you got any questions, comment below. Happy to answer them. And I appreciate you watching, and we'll see you next time.